Hello, I'm Mercyline Onyango from University, and I'm going to talk about investment, instrument, and risk management under financial literacy. And by the end of this session, you should be in a position to define the terms investment, instruments, and risk management. You should also be able to give the reasons as to why one may decide to make an investment. And lastly, you should be able to explain the importance of risk management. What comes into your mind when you hear of the term investment? Now, most people have heard that investing is the best way to accumulate wealth. It is the act of redirecting resources from being consumed today so that they may create benefits in the future. More precisely, investment is the use of assets to earn income or profits. It is a plan to put money to work today and obtain a greater amount of money in the future. And the essence of investment is to grow your money over time. Instead of simply spending it on immediate needs or wants, you putting it into something with expectation that it will increase in value or generate income in the future. Essentially, it is about making your money work for you, whether through stocks, real estate, businesses, or other assets with the goal of achieving financial growth and security. And before you make an investment, there are some of the key factors that you're supposed to put into consideration. Number one, investment horizon. This refers to the length of time an investor expects to hold an investment before needing to sell it. It is essentially the time frame over which an investor plans to invest their money. For example, if your father is saving for the retirement and he is 30 years old with a plan to retire at 65, his investment horizon for retirement saving is around 35 years. This longer horizon might allow him to take more risks with his investment as he has more time to recover from any downturns in the market. On the other hand, if he is saving for a down payment on a house he plans to buy in the next 3 years, his investment horizon is much shorter. So in this case, he'd likely want to invest in more stable, low-risk assets to ensure his money is available when he needs it. In conclusion, investment horizon guides your investment decisions and influences the types of assets you choose to invest in. The next consideration is financial goals. These are the specific objectives or targets that individuals or entities aim to achieve with their investment, e.g., lifestyle goals, wealth accumulation, retirement planning, home ownership, among other financial goals. And lastly, risk tolerance. This refers to an individual's willingness and ability to endure fluctuations or losses in the value of their investment in pursuit of potentially higher returns. It reflects both the psychological aspect of how comfortable someone is with taking risks and the financial capacity to withstand the potential losses. Now we go to the instrument. It is a means by which something of value is transferred, held, or accomplished. It is a tradable asset or a negotiable item. Under instruments, we have number one, stocks. A stock represents ownership in a public company. When you buy a stock, you are purchasing a small piece of the company. Stock prices fluctuate based on companies' performance, market conditions, and investor sentiments. There are two ways for stockholders to make money: through dividends and capital gains. Dividends are profits paid out 4 times a year to all shareholders. The size of the dividends depends on the profits of the company. Capital gains are when a stockholder simply sells their stock for more than what they paid for. If the stockholder made a profit, it is a capital gain. And if they lost money, it is a capital loss. Stocks can offer higher returns but also come with higher risks compared to other investment options. They provide a way to participate in the growth potential of businesses and the economy. A market for buying or selling stock is called a stock exchange market. Number 2, we have bonds. A bond is a fixed income instrument and investment product where individuals lend money to a government or company at a certain interest rate for an amount of time. The entity repays individuals with interest in addition to the original face value of the bond. Bonds are used by companies, municipalities, states, and sovereign governments to finance projects and operations. Owners of bonds are the holders of creditors of the issuer. Bonds are generally considered less risky than stocks but offer lower potential returns. Bonds come in various types including government bonds, corporate bonds, municipal bonds, and saving bonds. There are 3 components of bonds: coupon rate, maturity date, per value amount. Coupon rate is the interest rate that a bond issuer will pay to the bondholder. The time at which payment to a bondholder is due is called maturity date. Per value amount is the amount to be paid to the bondholder at maturity. Next, we have the real estates. They involve physical properties like land and buildings. A real estate is land and any building or structures on it. It is what we call the properties and places where people live, work, or do businesses. When you buy a house, apartment, or piece of land, you are investing in real estate. It is like owning a piece of the world. Investors earn money through rental income or property appreciation. Real estate often increases in value over time, offering potential capital growth. Real estate value can fluctuate based on economic conditions, location, and demand and supply factors. Also, we have mutual funds. These are pooled investments where people contribute money to be collectively managed by professionals who invest in stocks, bonds, or other securities on behalf of the group. Fund managers make investment decisions on behalf of investors based on the fund's objectives. Mutual funds offer exposure to a wide range of assets, reducing individual investment risk. Investors can participate in various markets with relatively small amounts of money due to the pooling of funds. Risk management is the continuing process to identify, analyze, evaluate, and treat loss exposures and monitor risks, control, and financial resources to mitigate the adverse effects of loss. Essentially, the goal for risk management is to identify potential problems before they occur and have a plan for addressing them. It looks at the internal and external risks that could negatively impact an organization. The importance of risk management include: number 1, protecting assets. It helps safeguard assets and resources from potential losses, ensuring the continuity of operations and protecting investments. Number 2, we have enhancing decision making. By identifying and assessing risks, organizations can make informed decisions and allocate resources effectively to minimize negative outcomes. Number 3, we have enhancing stakeholders' confidence. Stakeholders including customers, investors, and employees, have greater confidence in organizations that demonstrate effective risk management, leading to increased trust and support. And next, we have cost savings. Proactively managing risks can lead to cost savings by avoiding potential losses, reducing insurance premiums, and minimizing the need for reactive measures to address crises or emergencies. And lastly, we have compliance and governance. Many industries and regulatory bodies require organizations to have robust risk management practices in place to comply with the laws and regulations and uphold good governance standards. Risk management procedures involves several steps to identify, assess, mitigate, and monitor risks. The following are the steps involved in risk management. Number one, risk identification. Identify potential risks that could affect your project, organization, or goals. This involves brainstorming with stakeholders, reviewing historical data, and analyzing external factors. Number two, risk assessment. Evaluate the likelihood and impact of each identified risk. Use techniques like qualitative assessment, that is, rating skills based on probability and severity, or quantitative analysis, which is using data and models to assess risk exposure. Number three, risk mitigation. Develop strategies to reduce the likelihood or impact of identified risks. This could include implementing preventive measures, creating contingency plans, transferring risks through insurance, and avoiding certain activities altogether. Number four, risk monitoring. Regularly, monitor identified risks and their status to track changes and assess effectiveness of mitigation efforts, update risk registers, and communicate changes to stakeholders as necessary. Number five, response planning. Develop response plans for managing risks if they occur. This involves outlining specific actions to take, responsibilities, and triggers for activating response plans. Number six, communication. Maintain open communication channels to ensure stakeholders are informed about risks, mitigation efforts, and any changes in risk status. Effective communication helps stakeholders understand their roles and responsibilities in managing risks. And lastly, documentation. Keep thorough documentation of risk management procedures, including risk registers, assessment reports, mitigation plans, and communication records. This helps maintain accountability and provides a reference for future risk management activities.